Hello everyone. Welcome to our review of some answers. Hopefully you've already made an attempt with these exercises having to do with leases. And then you can check yourself with these answers and see where you may need to fill in any gaps. So exercise 1, because it fits one of the criteria, in this case a bargain purchase option, that it is a finance lease. So the lessor, all right, is going to record a leased asset, leased liability. The seller, in this case, a sales type lease, is going to record a receivable and sales or revenue. So to get the value, we're going to take present value using the rate explicit given, number of periods, 12, the $35,000 payment, and the $10,000 if you put right in the formula, $10,000 on the last one, and then we make sure that you put a 1 to make sure that it's at the beginning of the time period, not at the end, which is the default. All right, so that last parameter here. So I also showed that you could do it in 2 pieces by doing the annuity of the payments and the final bargain purchase option separately and add them together, and you get the same result. Okay, just 2 different ways you could do it and get the same result. So there's the journal entries. We record inventory and cost of goods sold on the seller side. Okay, then the first payment is made immediately, so that is all debited to the lease liability and credited to cash, or credited to lease receivable, debit cash. All right, then after a year, you've got interest on that balance. So you've taken out the $35,000 out of the lease liability, and you multiply your 10%. All right, you get interest expense, interest payable, and interest receivable and interest revenue on the side of the seller. So that entry needs to be made as an adjusting entry. Otherwise, you're missing that interest expense for the year. Depreciation we calculated using the full useful life because this is going to change hands. This is for sure going to be ours. So the lease term is not the term that we use for depreciation, but the life of the asset. Okay. Basically, the beginning of 2026, we make our payment. We credit cash. We debit interest payable for the amount that we recorded at the end of 2025. The rest of it goes to the lease liability. On the other side, it's just a mirror image. Cash comes in. Interest receivable is credited. Lease receivable for the remainder. Then we have, at the end of 2026, we record again the interest, interest receivable, interest revenue, interest payable, interest expense, and the depreciation is straight line. We just do the same thing as we did last year. So that's the first exercise. Second exercise is an operating lease with different payments. They go up each year. All right. So total payments are $33,000 whenever we have an operating lease, and they're different payments. We add them all up and we divide by the number, because we're going to treat it as if the amount of expense is $6,600, which is the $33,000 divided by 5. All right, so that's an operating lease. No entry to the landlord, if you will. It's not a seller in this case, a landlord. Rudolph does still record a leased asset, same way. Okay, present value of the payments. In this case, because they're different, we have to use net present value. All right, and we use net present value on the 4 payments in the future, plus the 6,000, because the 6,000 is right now, so we can't apply present value to 6,000. That happens immediately. So we just do present value of the 4 and then add the 6,000. That's 27,729. First payment is for 6,000, just as the lease said, but we record lease expense of 6,600. We record lease revenue of 6,600 for the landlord, and we use something to offset, make the difference, lease liability, unearned revenue, indicating that we've got revenue issues having to do on the landlord side. Okay, the next payment is the same way for Rudolph, except now our cash is 6,200. But notice that lease expense is the same, lease revenue is the same, and so you're only having to make up the difference of 400 to lease liability. And then we change our lease liability and leased asset to equal the new present value of the remaining payments. Okay, so that calculation over here, using the 9%, the last three plus the 6,200, okay, and that is 4,044 less than what it was last year. So we make the debit to the liability and credit to the asset. New payment, this time the only difference is the cash, and lease liability, the lease expenses stays the same as we would expect. And then we recalculate our present value using just the last two plus the 6,500, and that is 4626 less than it was last time we calculated that. So we debit the liability and credit the asset. That redoing of the present value is by far the sticking point of how we handle operating leases. And then finally, another finance lease, although this time there is not a sale per se. It is simply acting as a finance company for this machinery. All right, so there's a little difference in how things happen on one side versus the other, because the lessor, the one that is doing the leasing, okay, is going to record the present value of the future payments. Here's the present value of the cash payments. They do not necessarily pay that the value of the thing is not guaranteed. It's just a plan that they're going to give back. Their plan is always to give back the asset, and the lessee plans to get it back and maybe even be able to use it and lease it again or something. So we record the leased asset and lease liability at the present value of just the cash payments. The present value of the residual, as we call it, is calculated here, all right, using the same rate and everything. But we have two pieces, all right. The lease receivable, that's what we expect to get in the payments, which matches the lease liability. But we also plan on getting back the asset that we think will be worth $35,000, but that's right now $18,223. All right, that together adds up to $282,005, which rounded. It's a little different than the $282,000 that we thought was the value given in the problem, but close enough to say we're not making any profit on this. We're just leasing. We're just acting as the financer. Okay. First payment, just like before, lease liability in cash, lease receivable in cash. Then we have interest expense, interest payable. So on this side, it really does not look different than the other one that we did earlier, exercise 1. And we calculate the interest. We just do it on a different rate. Okay. Depreciation this time, though, is calculated on the lease term, not on the life of the asset, because we're going to give it back. Okay, so that's the plan. Okay, lease liability, interest payable, paid off, lease liability, cash, and then interest expense for another year with depreciation. And the difference on the other side is we're calculating, we're worried about the interest receivable, but it's calculated on both the receivable and the residual asset. All right, so that in that way, the interest payable, because this is what is going to be paid by the company, right? This is what is going to be received, but this we have to get this residual asset that's going to grow as we get closer to the end. And the theory is it'd be $35,000 when we get it, so we need to get it higher each time by the amount of the interest. There's your calculation up there. The difference between the interest revenue, which is calculated on the whole 282 that we actually loaned, and not just the 263, which is why it's different. Okay, and so forth. You can see the numbers there, the interest receivable, interest revenue. So you want to see that we're really calculating what the issue is here is we're calculating interest as a lessee, okay, on the residual as well as the amount of the payments that we're going to give it. So, and we separate that. Some companies will not separate it, but I did make sure you can see that there are two pieces to that, and it's much easier to track that way.